Recent tariffs have been a concern for growers across the nation. To try and help ease the financial burden, the government is offering a $12 billion farm aid package. Nebraska Extension Policy Specialist Brad Lubben says the package will target producers of certain commodities and contains 3 distinct components. Brad sat down with us to explain more about the package.
Well, the Secretary of Agriculture announced a $12 billion package of assistance for agricultural producers to at least partially offset the losses of current trade conflicts and lost trade opportunities. That package includes some familiar tools from years gone by, but one of them would be direct payments to producers, effectively market loss payments or payments to help recover from lost market prices. In announcing this aid, there was certainly an announcement of some major commodities, thinking of major row crops, corn, soybeans, sorghum, wheat. Think also of beef and pork, amongst other commodities. But the list is pretty long, in fact, of commodities that have been hurt or at least are feeling the repercussions of the trade conflict. So a second component would be commodity purchases of those surplus commodities to help reduce market supplies, to end up distributing some of those commodities through food distribution and assistance programs. And then the third component would be increased commodity promotion and trade promotion programs. Now, we already have trade promotion programs within USDA. This may simply be additional funding to help increase those programs and build new markets elsewhere. This is really intended, it appears, as a package to try and address market losses, commodity losses in commodity value across the farm sector. The fact that this package was announced as emergency assistance to agriculture for what effectively are economic losses is uncommon, but not unheard of. We can go back to previous sort of trade conflicts, even self-imposed trade conflicts. Nixon's price controls of the early 1970s and some of the lost agricultural market exports. Carter's embargo on Russia in the late 1970s, 79, that led to some calculated price losses. And we can see the need for sort of an economic response to the pain caused in agriculture when a policy decision hurts the sector. We can also back up much more recently to the late 1990s when agriculture lost substantial income and market price levels as a result of trade concerns, but market-driven trade concerns. Currency crisis in Southeast Asia led to weakening economies, weakening demand for U.S. ag exports, substantial drop in market values. We saw emergency responses then in response to those lower market values, perhaps somewhat on the magnitude of what we're seeing today. So it's not unheard of in terms of responding to trade losses or responding to economic needs, and the magnitude is not particularly shocking compared to those previous levels. This might be unique in the sense that this is an assistance package to help alleviate pain caused by the same administration's trade policy decisions. So some could argue it's a self-inflicted wound. This is a Band-Aid on a self-inflicted wound. How long it provides relief and how long we need relief remains to be seen. You know, the $12 billion proposal is intended to help offset some of those losses, some of that pain of the current trade conflict and the impact of tariffs that the U.S. has placed on foreign exports to the U.S., retaliatory tariffs coming from those foreign competitors, all affecting the value of certain commodities. And for agriculture being a major export-driven sector, obviously export commodities from the U.S. are where you're going to retaliate. So we've seen substantial losses in those markets. We've seen corn and soybeans and other grains, for example, lose more than 15 to 20% in market value since the late May highs. They've recovered a little bit here in the past week or so, perhaps with some optimistic news for assistance or for potential resolution, but we've certainly lost a lot of value. While this package of assistance may provide some relief, and certainly the underlying farm bill, the current bill as well as what's being negotiated in a potential new farm bill, provide an underlying safety net for program commodities, it still ends up on the producer's shoulders to manage for the market and the market uncertainty that we have. We've been adjusting to lower price expectations and hopefully ratcheting those expectations into production decisions and cost of production over the last 4 years. Now we have dealt with another shock this year in terms of trade conflict and uncertainty and potential loss of markets. We have to deal with those one way or another. The safety net programs, the emergency assistance will provide some relief, but they really fundamentally don't replace the need for good management, sound management, conservative decisions on the farm. Whether these payments are sufficient or sort of full coverage for those losses, we have to wait until rules are announced, apparently, and looking forward to those in September. But we would expect some form of per bushel or per hundredweight calculation to come up with an assistance payment. Will that be on current production? Well, then we'd need to prove 2018 production. We'd have to go through a process, certainly at the Farm Service Agency office. So it's not as simple as just sending out checks in September. We've got to figure out exactly which commodities, what the enrollment process looks like. But at least we can rest assured that there is some assistance on the way.